Good afternoon, ladies and gentlemen, and welcome to the Q3 FY2023-24 earnings call of Pondy Oxides and Chemicals Limited, hosted by AlphaStreet. This is Radhakrishnan Chonat from AlphaStreet, and it's an absolute pleasure to host Pondy Oxides and Chemicals Limited for their quarterly earnings results conference call. From the management, we have Mr. Ashish Bansal, Managing Director, Mr. K. Kumaravel, Director of Finance, Mr. Vijay Balakrishnan, CFO, and Mr. Piyush Dhawan, President, Commercial and Strategy. As a reminder, today's call is being recorded. For professional investors, we are live streaming this audio along with the AI-generated transcript on alphastreet.com's AI platform. A replay audio of this call will be made available on alphastreet.com's platform as well as on our AlphaStreet India YouTube channel. A final transcript will be made available shortly afterwards on AlphaStreet's platform. With that said, may I now request Mr. Ashish Bansal to take you through the financial performance and highlights. Post that, we can start with the Q&A session. Over to you, Mr. Ashish.
Thank you, Mr. Radhakrishnan. Good afternoon, everyone. We wish you a warm welcome to POCL's third quarter earnings call. We will briefly discuss the financial performance and highlights. As you're aware, we don't provide any specific guidance on our company's revenue or earnings, and any communication or discussions on this call which reflect our outlook for the future and which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company may face. Before discussing the financial results and performance of the company, I would like to brief the current market scenario of lead. The lead-acid battery recycling market has been steadily growing over the past few years. The global lead-acid battery market size will grow at a CAGR of 6%. The Asia-Pacific region dominates the lead-acid battery recycling market and accounting for more than half of the global market share, and India being one of them with its increasing share year on year. Overall, the market shows promising growth potential in the coming years as more countries shift towards circular economy models where products are designed for reuse and recycling, thereby presenting an opportunity for manufacturers to recover valuable materials from used batteries and recycle them into production cycle, and the need for reliable energy storage solutions will continue to rise, driving demand for lead-acid batteries as well. In conclusion, the future outlook for the lead battery recycling market is positive with significant growth predicted in the coming years. With respect to the quarterly revenue growth, POCL has reported a total revenue of 454 crores with a growth of 16% in terms of value and 12% in terms of volume from the previous quarter in the current year. Revenue from the operations when compared to corresponding quarter of last year, FY2023, have substantially increased by 22%. For year-to-date numbers, POCL has reported sales amounting to INR 1,168 crores. The increase in value terms is about 13% when compared to previous year. Our EBITDA levels in lead vertical for this quarter were in the range of 6.04% versus 5.20% for the previous quarter of last year. Overall, POCL has achieved an overall EBITDA of 5.40% due to lower realization in aluminium division and other related operational expenses. In relation to ratios, the current ratio is at an optimum level of 1.47 and debt equity ratio is at 0.83, which is well within the industry standards. The return on capital employed for the Q3 FY 2024 stood at 27%, and our sales mix comprised about 45% domestic and 55% exports. The company has also obtained the assent of shareholders in the EGM held on 6th February 2024 for raising capital to a tune of 133.50 crores by issue of equity shares and warrants on preferential basis to the promoter group and to certain identified non-promoter persons by our entities. On receipt of SEBI approvals, the allotments will be completed. We have already started procurement of machinery, execution and development of the expansion in lead project at our newly acquired company at Kandigai in Tamil Nadu, where we are increasing capacities in lead vertical from 132,000 metric tons per annum to 204,000 metric tons per annum in phases. The installation will commence in June 2024 and will be commissioned by September 2024. We appreciate you all participating in today's call, and over to you, Radhakrishnan.
Thank you, Mr. Ashish. We'll now move into our question and answer session. Today we have participants joining via the Zoom webinar platform and also via the telecalling platform. Participants who have joined us and connected us through the Zoom webinar platform can post their questions directly to me on the chat box, and we can ask the questions on your behalf. Or alternatively, if you wish to ask a question directly, please use the raise hand functionality. And as usual, I'll take the first few questions from the chat box as well as questions we have received via email and through our AlphaStreet platform. And then we'll open it up to participants to ask questions directly. Once again, ladies and gentlemen, please use the raise hand functionality if you would want to ask a question directly to the POCL management, or use the chat box to ask a question. I'll start with the questions that we have received via emails and through our platform first. The first question is, can you tell us more about the recent MOU that your company has signed with the government of Tamil Nadu?
Kumar will take this question. We have proposed to set up a state-of-art recycling and manufacturing plant in Tamil Nadu for non-ferrous metals, lithium-ion batteries, paper, plastics and rubber, and the government of Tamil Nadu has agreed to offer facilitation and support for implementing the project. These are under feasibility stages and are being discussed internally on techno-commercial grounds to evaluate the opportunities available at hand and translate them as commercially viable projects for the company. The company has planned to invest in the range of rupees 300 to 500 crores in the proposed projects in the next 5 years. This is projected to generate additional revenue of rupees 750 crores per annum for the first phase, and thereafter on an incremental basis with other projects coming in.
Thank you, Mr. Kumarvel. The next question is, how does the company intend to fund its capex of rupees 500 crore, with which the company is going to set up the recycling and manufacturing plants in Tamil Nadu? And can we expect a dip in the margins of the company due to this MOU?
Hi, RC. This is Vijay. The planned capex of INR 300 to 500 crores would span over a period of up to 5 years. POCL has raised INR 133.50 crores in equity to fund its initial capex growth phase through the preferential allotment. Future requirements of funds will be decided on business fundamentals and the global economic scenario at such point in time. Maybe an ideal mix of debt and equity will enable us to have an overall weighted average cost of capital at relatively lower levels, consequent to which our profitability will improve along with our top line.
Thank you, Mr. Vijay. The next question is, can you share the numbers in terms of working capital for this quarter as compared to the quarter last year?
The working capital amount as of December 2023 is INR 275 crores when compared to INR 240 crores in the December quarter last year. This is attributed to an increase in inventory and debtor levels for aluminum vertical when compared to last quarter of the previous year.
Thank you, Vijay. The next question is, can you provide an updated breakdown of your sales between exports and domestic markets for Q3 FY24?
I will take this question too. The geographical sales mix of POCL is made up of about 45% of domestic sales and 55% export sales. Having additional verticals in aluminum and plastics, we will also gain access to a wide array in the domestic market concentration in the coming months.
Thank you, Mr. Vijay. The next question is, can you share a roadmap on how the company intends to grow in the foreseeable future?
So hi RC, Piyush here. I'll take this one. So lead is our core vertical as of today, and significant steps have been taken to develop other verticals like plastics and the aluminium division. We are currently expanding in lead vertical at a newly acquired company in Pondy in Tamil Nadu, and further increasing capacities from 132,000 metric tons per annum to 204,000 metric tons per annum in phases. In addition to lead vertical, we have built a very strong platform and a diverse portfolio with visible business opportunities in plastics, aluminium, and copper. In parallel, with the markets evolving in real time in lithium-ion, rubber, and paper, we continue to see progress in techno-commercial feasibility, which will eventually translate to yield positive strategic growth in the short to mid-term that has an overall longing impact on the long-run growth of POCL. This will get added to our top line and the bottom line in the financials, and such new additions will happen over a period of time.
Thank you, Piyush. Let's move into the live audience questions. We have Harsh Maru. Operator, can you make Harsh Maru join the call to ask a question? Hey Harsh, go ahead and ask your question.
Thank you so much. Am I audible?
Yes, go ahead.
Thank you for this opportunity. So my question basically relates to this expansion. So we now have about 130 crores of equity with us as we conclude the pref issue. So what is the total funding requirement that you need to go from 32,000 tons of capacity to around 200,000 capacity? And what is the ideal debt equity mix that we are looking at in terms of the expanded capacity?
Yeah. Sir, Kumar will answer this question. As we informed in my earlier communication regarding the MOU, this investment of 300 to 500 crores in phases. So out of this 133 crore preferential issue, initially we get about 70 crore now before the end of March 24, and the balance we get after 18 months. So that will be utilized for the second phase of utilization. So initially we utilized this 70 crore for our immediate expansion at Tiruvaikandigai, Tamil Nadu, where our immediate requirement is in that range only. And the other expansion required in the existing units, meet it through the internal accruals. Immediately, we are not going for any term loan proposal, that is not in the card. Maybe in the future, depending upon the requirement, we go for the debt and equity mix later on, not now.
Okay, and in terms of basically our this expansion, the facility that we'll be having now, would it be any different from our current core capacities? Would they yield better margins in any form? Are we building any better efficiencies in this expanded capacity? If you can throw some light on that.
Yeah, Harsh, this is Ashish here. Yeah. This current plant that we are installing is definitely a much more modern plant with some addition on technology front as well. And definitely, yes, there will be better efficiencies and higher automation, and the running cost will be a little lower than our existing operations on this new capacity.
And we are sorted in terms of the sourcing for the expanded capacity as well.
Yes, we are.
And just one last question, in terms of value-added products, what is the kind of mix that we have currently, for the third quarter and probably right now? So anything that we are selling which is a premium to LME in terms of lead. So what would be the broad proportion of that quantity be like?
You're asking if the products other than the pure lead product, or you're asking else something else?
Other than pure lead product, basically.
Yeah. So currently our sales on pure lead is only in the range of close to 35%, give or take a couple of percentage. And the balance 65% is on various alloys and specific products that are manufactured specifically for customers, like custom-made alloys. And going forward, more or less, I mean, there can always be a 5% plus minus, but more or less the product mix would remain in similar ratios.
Thank you so much, sir, and all the very best.
Thank you.
Thank you.
Thank you, Mr. Harsh. Ladies and gentlemen, once again, if you would like to ask a question directly, please use the raise hand functionality, or alternatively, you can ask your questions through the chat window. We have a couple of questions coming in via the chat window. The first question is from Mr. Darshil Javeri. What kind of year will FY25 be? Can we see 20% growth in FY25?
Yes, I'll answer this question, Javeri. So, the expected right now, last year, if you see, our turnover was about 1,474 crores. And for next year, we can expect round about from 1,700 to 1,800 crores will be our expected turnover.
Thank you, Mr. Vijay. Next question is from Bhavesh Chauhan. The company will be in receipt of rupees 500 crore due to this preferential issue. Can you explain the deployment of this amount, please?
Deployment of this preferential capital amount you are talking about?
Yes, yes.
Yeah, that just I explained. No, this initially we are getting 70 crore from preferential issue before March 24, which will be utilized for our new expansion going on in Thiruvaikandigai, Tamil Nadu, and for lead automation plant. And for the balance, we'll get only after 1.5 years, 18 months only we'll get that balance amount. That anyhow, we are having second phase of expansion of different metals in the same venue or different venue already we discussed, in our opening meeting. All this thing we'll spend in the later on period after 1.5 years.
Thank you, Mr. Kumarvel. The next question is from Mit Masalia. I hope I pronounced it right. The question is, will additional demand generated from expansion be entirely value-added products?
Like I just spoke, I mean, the entire production will not be value-added products, but it will be in similar mixes, about 35-65 or 40-60. It will be a mix of both.
Thank you, Ashish. Ladies and gentlemen, if you would like to ask a question, post it on the chat window, or you can just raise your hand and ask it directly. There's a follow-up question from Mit Masalia. Is the company looking to export the same to leading South Asian battery players? The question is vague, but the question is the company looking to export the same to leading South Asian battery players?
So, Meet, just to give you a little background on POCL, POCL is one of the largest exporters of its these lead products in India. And we have been exporting this for almost over 15 years now to all these Southeast Asian countries and directly to the OE manufacturers of batteries and all the large battery makers, the tier 1 battery makers specifically, to countries like Japan, South Korea, Thailand, Indonesia, Vietnam, Malaysia, Middle East, Bangladesh, multiple, almost in excess of 15 countries. So we are already doing that. And going forward as well, from this production plant also, it will move to similar locations and other more locations as well.
Thank you, Ashish. The next question is from Aniket Gada. What is the segment-wise revenue breakup for Q3 and also capacity utilizations for all the segments?
So I will take this question. So in terms of lead division, the revenue is about 1,000 for YTD numbers. It is about 1,125 crores. In terms of aluminium, we have done about 40 crores, and in plastics we have done about 15 crores for the last 9 months. In terms of capacity utilization, we are in the range. In lead division, it's about 60 to 65%, and in aluminium it's about 20%, and in plastics about 25%.
Thank you, Mr. Vijay. The next question is from Prathamesh Diwar. Sorry if I missed it, but how are we looking at margins and exports as a percentage of sales and the overall revenue guidance for FY24 and FY25?
EBITDA margin is in the range of 6% at present on lead division. Once we have a Thiruvaikandigai plant in operation, EBITDA margin we are expected to get more than 7% in that new plant. So overall EBITDA margin will go further.
Thank you, Mr. Kumaravil. Ladies and gentlemen, if you would like to ask a question directly, you can use the raise hand functionality. Once again, as a reminder, we have a few more questions from the chat window. It's a follow-up question from Darshil Javeri. What kind of margins can we expect? Will we have operating leverage with better revenue? Is 1,800 revenue conservative as in Q3, as we have already reached the run rate of 1,800 crores? I hope that makes sense.
Yeah, I mean, for the next financial year, definitely 1,800 is on the conservative side. And looking at multiple, global phenomena and factors, we have definitely given a conservative number. So, I mean, that's the best we can say, but definitely yes, 1,800 is a conservative number. We will definitely strive to attain more.
Thank you, Mr. Ashish. There's one more follow-up from Darshil again. What kind of seasonality do we face?
So basically, our sales predominantly we believe in very less amount of spot sales, and most of our sales are governed by long-term contracts. We sign annual contracts with all the large OEs, and maybe 3 to 5% maximum of our sales are on a spot basis, and that's more on opportunity based or any specific extra value added product that we get, or that's also to support some of our existing customers where they need some extra raw material of sorts. So generally, in excess of 95% of our sales is done on long-term basis. So
and there is no seasonality in this business as such.
Yeah, because since we are also present in multiple geographical locations, even if one particular country has a cyclical thing, the other locations cover up for it. So similarly, it balances out the whole sales.
Thank you. Thank you, Ashish and Kumaravil. The next question is from the line of Navneet Bhaiya. Why are the EBITDA margins of the company lower than its listed peers? And what are the company's growth aspirations in the medium term, 3 to 4 years CAGR? And can we do 20% CAGR given the focus on recycling?
Yeah, our EBITDA margin is intact. In fact, it is better than the previous quarter. If you see, already we discussed on that. Anyhow, we don't want to comment on the EBITDA margin of the other players. We can talk about our company on this. Our EBITDA margin is constant. It is in the increasing trend in the lead division.
Thank you, Mr. Kumaravil. Follow-up questions from Aniket. Any update on EPR and battery waste management rules? Any concrete steps from the government's end?
Oh, hi, Aniket. On EPR, still EPR is at a very nascent stage, and with regard to the battery management handling rules, battery waste management handling rules, the CPCB has put up a dashboard on its portal, and most of the recyclers are getting registered. But in a more transitional way, I would say in the next 3 to 6 months, we would see certain amount of opportunities transitioning into commercial viability for EPR. There are a lot of players in the market who approach recyclers like us to kind of exchange raw material and get a finished product in addition to the EPR certifications. Although at a nascent stage, I would still say that over the next 6 to 9 months, we would see a lot of opportunities progressing in this form of business line.
To supplement Piyush, here in Tamil Nadu, that software under development in this pollution side. So we are not able to progress much on the EPR registration in Tamil Nadu, though it is live in other state of Andhra Pradesh. There already it is in the completion stage. Tamil Nadu will not be able to proceed because of they are not developed the software. It will take time, it seems, for EPR registration.
Thank you, Piyush and Kumaravil. Again, one more follow-up from Aniket. Any update on the green lead manufacturing?
So green lead, unfortunately, I would have to comment that it's still under progress. We are again conducting trials, and we are in touch with our partners to check the feasibility and the commercial viability. Maybe by the next quarter or so, we'll be able to comment on a detailed level on how the progress has been made and how the yields have kind of recovered. So that's basically all as of now.
Thank you, Piyush. Next, we have a question from Prathamesh Divar. What will be our export % of sales in the coming years?
So as of now, the export is at about 55%, and domestic is at 45%. We are concentrating on exports in the coming future as well as expanding our domestic base. So relatively, we foresee similar proportions, but the numbers will increase in a transitional way.
Thank you, Piyush. I'm going to request if there are any more questions, please use the raise hand functionality or use the chat to ask your questions, ladies and gentlemen. Okay, we have a few more questions coming in via the chat window. Next one is not a question, but more like a comment from Harsh Maru. A small feedback to the team, if we can share segmental revenue, EBIT, and volumes in a quarterly presentation stock exchange, that'll be very helpful. Thank you, Harsh. We'll see what we can do about it. Next question is from Chirag Mehta. When the revenue start flowing from MOU with Tamil Nadu government, what will be the asset turnover from that and expected margins? Also, what about the funding of 300 to 500 crores?
Regarding the funding part, I think it has already been explained. In terms of the revenue, in the first phase, that is the first part of the project, we are looking at about 750 crores of top line from the first phase of expansion. And going forward, as we add on the next phases, similar revenue top line growth will be there.
Asset turnover, 10 to 11 times.
Yeah, asset turnover would 8 times. 8. Asset turnover should be around 8 times.
Thank you, Ashish. Ladies and gentlemen, once again, I'm going to give a few seconds to see if there are any follow-up questions on the line. And as a reminder, if you have any questions, please use the raise hand functionality or use the chat functionality to ask questions directly to the Pondy management. There is a follow-up question from Chirag Mehta. It's too brief, but I'll still go ahead and ask. Sir, about expected margins. So his question is about expected margins.
Like Mr. Kumarvel spoke just a while back, the expected margins from this specific plant should drive up a little bit, and the overall margin should be in the range of 7%, which is currently now in the range of 6%.
Thank you, Ashish. There's a follow-up question from Mit Masalia. What is the progress on lithium-ion recycling unit?
So, on the lithium-ion recycling, it is right now at feasibility stage. We have made some progress with respect to R&D on the same, and we're kind of evaluating the techno-commercial feasibility of this particular form of recycling. It is still, I would say, at a very nascent stage. But what happens is the procurement is the key. A continuous procurement, I would say, is the key to have the entire business model in place. Probably in the next 2 to 3 years, we will see a lot of potential happening. But I mean, notwithstanding that, the fact is that we need to develop the form of recycling, the technology on the recycling front today, and we are working towards that, and we are getting prepared because we know it is eventually going to happen, maybe today, maybe in the next 3-4 months, or within the next 2-3 years. So we are at a pretty advanced R&D stage, I would say, and you will see some progress and announcements on the same maybe in a couple of quarters as such.
Thank you, Piyush. It's a follow-up question again from Darshil Javeri. When will capex of first phase be completed, and how will elections impact us?
Our expected arrival of the missionaries from foreign countries in April or May. So by the time election in South India will be over, that's what we presume. So that will not affect our implementation or erection of missionaries. Probably we go on. And our team is separately, they are working on it, and that is nothing to do with the India general election.
Thank you, KK. There's one more follow-up from Chirag Mehta. What are the expected margins from MOU with TN government you are talking about?
No, I think the question is a little vague. I mean, expected margins from the MOU with TN government.
Yeah, we'll give it a pass.
We can bifurcate into 2-3 segments. The lead segment already we are given profit margin segment answers already were given by both of us. And other products like paper and other this thing, that is we cannot comment it on right now. Only at the time of implementation, maybe after 1.5 year, 2 year only we can comment about it.
Thank you. Ladies and gentlemen, I request you to either raise your hand where you can ask the question directly, or through the chat window. Please make sure the questions are legible. Thank you. The next follow-up question is from Aniket Gada. Any updates on the lead recyclers? Any consolidation happening in terms of number of players in the lead recycling? Also, at what capacity utilizations do aluminum and plastics division break even?
So regarding the lead part, let me answer. So definitely with the thrust from the government in terms of the complete circular economy and a lot of other environmental factors, they're getting a little more firm in the processes of collection, the EPR process and all of it. It has to finally boil down to more stable players who can manage the operations in a more organized manner. So in the due course, we're already seeing a couple of smaller players facing the heat on this front and unable to manage. So we definitely presume that maybe in a year or two there could be a good cleanup on this space, and the strong players will evolve further in terms of not only in lead, in any kind of recycling.
So on the second part of the question where you've mentioned at what levels will plastic and aluminium break even. So I'll first touch upon the plastic part. So plastic, we have a capacity of 9,000 tons per annum. That translates to 750 tons a month. The break even would be within the range of 400 to 450 metric tons per month. And right now, what we are, have been successful would be the fact that the empanelment with the major the OEMs are more or less done and dusted. The only part is that we need to kind of scale up to those numbers to 450 plus, 500 plus, where we will eventually see the profit margins coming in and the margin of sales also showing in the financials. With respect to the aluminium division, again, we have similar capacities. Unfortunately, what the aluminium industry is right now going through is a very downward trend. It's probably at a trough stage of a business cycle where you see the aluminium prices, a lot of volatility. I mean, it's a good place to be for die casters, but not for the aluminium recyclers. But then that's not something which will be static. It will kind of eventually improving in the coming months, as we understand. And for us to break even, we would, I mean, since the capacities are almost at par with what we manufacture, so say around a number of 500 to 600 tons a month would translate to break even and also generating a good margin for the shareholders here.
Thank you, Ashish and Piyush, for answering that question. Ladies and gentlemen, I'm going to give a few seconds to see if there are any more questions or comments from the audience. Darshil Javeri has raised his hand. Operator, please allow him to ask a question directly. Hi, Darshil. Please unmute and go ahead and ask your question.
Hi, sir. Hopefully, I'm audible.
Yes, go ahead.
Yeah, hi. Firstly, sir, thank you so much for answering all the questions with such clarity. And as you know, most of my questions have been answered. So just a small question that relates to our capex. So, just clarify what you've said or summarize maybe. Our first phase we are starting right now, and we've already ordered the machineries. That would get completed in 18 months, and after that we'll use our remaining preferential issue shares, the money that we have, and that would start the second phase. Is that right, sir?
No. Actually, this two parts we raised the issue now. One is preferential issue of 51 crore coming immediately, and balance of the 80 crore, 25% of that 80 crore will come immediately from the warrant account. That 75% of the warrant only will come after 18 months. So we are going to utilize this 70 crore for our immediate project coming up in Thiruvaikandigai. Apart from that, in the corrigendums given to the shareholders, one portion we are going to utilize for the working capital purposes as well as general corporate purposes. That breakup also we are given in the corrigendum communicated to the shareholders. So we cannot raise when we cannot wait for 18 months to come. Then after that raising funds not possible. Funds is coming in two phases, and SEBI approval we are getting immediately for the entire amount. That balance of amount will be utilized for the second phase of expansion.
So the first phase of expansion, the machines will be arriving somewhere around April end, and the commissioning will start. So we are targeting, as said earlier, to start the production by the first week of September to do the trial productions.
Yeah. And so after trial production starts, so it would take around how much time for testing, and commercial operations would start maybe in 3 months, or how much time?
Commercial operations would start, hoping everything goes well in the trial production, within a month's time, the commercial operations can start in full swing.
Oh, perfect, sir. And so as we said, I think around 40 crores we have earmarked for plant and machinery, and rest a lot of it for working capital. So total capex on just the new plant, how much are we spending currently, like the first phase as we are speaking about, and that would be how much, sir?
Yeah, total capital expenditure on this project is 70 crore.
Okay, 70 crore. Then for that we expect an 8 times asset turnover, correct?
Yeah, yes.
Oh, okay, perfect. So that helps you, that clarifies everything, sir.
Yeah, because of that only we arranged the preferential amount in such a way to meet out the immediate requirement of capex.
Oh, perfect, sir. So sir, H2 maybe you should say turnover coming from this. Hello?
Your question is not clear, sir.
Yeah, sorry, sir. So sir, H2 should seek around revenue coming from a new plant, and we would be
H2 of 24-25 we get revenue generation from the new unit.
Correct, sir. And roughly that would be like, we could expect maybe around 150 crores, because even capacity utilization would take some time, right, sir? Of the new plant, we could expect around that much to come in.
Yeah, yes, definitely. Definitely we get around 150 crore, 200 crore turnover from that.
Oh, perfect, sir. And it would take how much time to reach optimum capacity?
If everything goes well, maybe after 12 months, probably we'll achieve that.
Okay. Perfect, sir. Thank you so much, sir.
Probably the first half of FY26, first 2 quarters of FY26 would when optimum production capacities will be attained.
He's talking about full utilization.
Full utilization.
Yeah, and the full utilization would be around 80%, right? Or we could do 100% also, right?
Yeah, we can go up to 100% theoretically and technically also.
But
Generally, we keep it at the 90% level.
Oh, no. Perfect, sir. Thank you so much for answering all my questions. So, thank you so much, sir. All the best for the next podcast.
Thank you.
Thank you.
Thank you, Darshil. As a reminder, ladies and gentlemen, if you would like to ask a question, you have two options. Use the raise hand functionality to ask a question directly, or the chat function. All right, ladies and gentlemen, that's all the time we have allocated for today. Please do send in your additional follow-up questions by email to us, and we'll follow up to get those answered by the POCL management. Thank you all for joining us for the Pondy Oxides and Chemical Limited Q3 FY2023-24 earnings call. And as a reminder, today's call was recorded. A replay of this call will be made available on AlphaStreet India's YouTube channel as well as our alphastreet.com platform. A final transcript will be made available shortly on alphastreet.com. Thank you everyone for joining us today, and thank you Pondy Oxides and management team for the call. Appreciate it.
Thank you. Thank you, Radhakrishnan.
Thank you.
Thank you, everyone.
Thank you all.